All right there, finance friends. Welcome back to our next video. So as you know, in this section of our course, we're moving into investments, those tools where you put some money aside, having been net cash positive and having saved up, and you put that money aside, you invest it in some sort of medium, some sort of asset class, we called it. And remember, each asset class has its own particular risk and reward trade-off and its own set of advantages and disadvantages. So anyway, you put this savings into these investment vehicles with the hope of getting some future benefit, okay? In our first detailed video today, we're gonna cover stocks. I want to repeat the caveats that I gave you before. I want to advocate that you do not begin your investing career with stocks. There's probably much better, far better alternatives, mainly mutual funds. But it is important that you understand some basics of stocks and how the stock market operates. And that's the purpose of this video, okay? But again, big caveat, big warning. I strongly advise that as beginning investors, you do not buy individual stocks. You're gonna miss out on diversification. I believe that you should start with mutual funds. However, it's important to understand your asset classes. So with those caveats in mind, let's jump into stocks, okay? So one of the first things that we have to bear in mind is that of all the asset classes, of all the major ones, stocks have consistently delivered the highest return over the longest period of time, okay? So of all the asset classes, stocks, and again, they're also known as equities for reasons that we'll be clear in a bit, stocks have consistently provided investors the highest return over the longest period of time, okay? By definition, what you need to know is that a stock is effectively a share in the overall ownership of a company. So when you purchase stock, you are effectively becoming a partial owner in that company. Now, a lot of this is going to be jargony, so let's break down the different types. There are generally two types of stocks that you can own. The first one, which is the most, as the name says, common, is in fact called common stock. And the second type of stock we would call preferred stock. So within the stock market, within that asset class, there's two primary stock vehicles. There's common stock and there's preferred stock. Let's break them down with definitions as well as some of the technical parts of each one. So common stock is the most basic and the most widespread of all of those types. When we're talking about common stock, here's the big takeaway. Each person who owns a share, and we're going to call those people shareholders or stockholders, they also own a proportionate share of the company. So when it comes to common stock, each person who owns a share of common stock also owns a proportionate share in the ownership, and therefore in the assets and in the income of a corporation. So in other words, what we would say is that common stockholders have what is known as a residual claim. And this is an important term. Residual claim refers to the fact that legally a common stockholder owns a share, and they have a legal right in the share of the income and assets of a corporation. However, critically, they only have those asset and income shares kick in after what we call higher priority claims have been paid. Those higher priority claims would include things like interest payments to bondholders, as well as the dividends that go to preferred stockholders. Okay, so there's a lot going on here. So again, if you own a share of common stock, you own a part of the company. Therefore, you are legally entitled to what's called a residual claim in that corporation's assets and income. However, your legal rights are secondary to the legal rights of other people, namely bondholders who have a right to interest payments and preferred stockholders who have a right to dividends, okay? The other thing that common stockholders have are voting rights. And this is really important. As a common stockholder, you have, and again, it's all proportionate to what you own, but you have the proportionate authority to express an opinion or to express a choice in all of the big matters that affect the operations of the company. In practice, this means that common stockholders have voting rights when it comes to electing the board of directors of a company. And in theory, at least from the world of the fiduciary obligation, the board of directors have a fiduciary obligation to represent the shareholders in overseeing not the day-to-day operations, because boards of directors rarely oversee day-to-day operations. That's the management's job. But the board of directors, they're looking at the big picture, and they're really the stewards who have a fiduciary obligation to look after the interests of common stockholders, okay? The other thing that you need to understand is that legally, while stockholders have residual claims and they have voting rights to have elective voice in the board of directors, for example, they also have limited liability. And what that means is this: suppose that you have a share of stock in a company. If that company does something bad, something illegal, that company gets sued, you as a common stockholder are typically not liable personally for those lawsuit claims. In other words, your liability is limited to the amount of money that you invested when you purchased those shares. You typically cannot be held as a common stockholder liable for any misdeeds or other issues that a company does. So if, for example, you own shares of ExxonMobil stock, ExxonMobil crashes a vessel, they have a massive environmental disaster with an oil spill, ExxonMobil might get sued. You have liability insofar as the value of your shares might decline or even get wiped out, but you have no personal liability. In other words, you as a shareholder cannot be personally sued. And that's part of the benefits of the common stock legal system. There's a legal barrier between the corporation and the investor, okay? So that's what common stock is. Typically, if you invest in common stock, you're doing so with two expectations. And again, this is where the board of directors kicks in to kind of look after your interests. The first the first goal that you have, the first, we'll call it expectation that you have, is that the corporation will be profitable enough so that the company's income, the money that it brings in, exceeds its expenses. So you expect the income that the company brings in to be greater than that company's expenses. In other words, you expect your shares to generate what we would call a net profit. Net profit. Net profit being the difference between the income that comes in and the expenses that go out. So as a shareholder, you have an expectation that your company will be profitable, specifically profitable enough that the company will be able to pay you as a shareholder what is known as a cash dividend. A cash dividend is effectively a proportionate share in the company's profits that are distributed to you as a shareholder as a reward for your partial ownership in this profitable endeavor, okay? So you expect that at least one expectation is, if you're a shareholder, that company is going to make sufficient profit to enable it to provide you a dividend, okay? Technical term here, a stock's dividend yield. This is a little mathematical formula that we'll get. A dividend yield is the percentage return provided by a company's dividends. So we would define dividend yield as the annual dividend received per share divided by the market share per price, okay? So that's one of them. I want to make one more point regarding dividends. Some companies pay dividends, some companies don't. Oftentimes, the companies that pay them, they advertise or they push that dividend payment as the part of the incentive to buy the firm. You might be asking why some companies don't pay dividends. And there's a few answers. Some companies, if they're not operating well or if they're not generating massive profit, they just don't have the free cash to pay out. But sometimes even really profitable companies will not pay dividends. And the answer to that is that those companies may be in a growth mode. So rather than take some of their profits and distribute it to you as a stockholder, they might prefer to plow those profits back in to the company to expand operations, to expand scale, to push marketing, to grow market share. So sometimes you'll get dividends, sometimes you won't. If you don't, it can be because the company may be in growth mode. But going back to the expectations that we're talking about in this section, if you buy a stock that advertises or that promises dividend, you have an expectation that they'll generate enough profitability to make that promise. And that's especially true with older investors. You can imagine an investor who is getting near retirement age, they may be looking for steady, stable income streams coming in. And oftentimes dividends provide that. So anyway, one expectation, you're going to get a dividend. The second expectation that you have as a shareholder is that over time, the market price of your stock will increase. And therefore, this would allow you as a shareholder to earn the term that you now know is a capital gain. Okay. Now, this goes back to the form that we learned before. We had said that there's two components of any kind of investment return: the current income, meaning the income that you pull in while owning it, and the capital gain. What we see here is that, get rid of those settings, forget that. We see here the two parts. Shareholders of stock, they want to make dividend and they want to get capital gain, okay? In terms of capital gain, there's a couple of terms you need to know because it is very jargony, but you don't want to make mistakes, okay? Well, we talk about what's called a realized gain. A realized gain refers to the actual capital gains when a share is actually sold. Okay, so realized gains occur when you sell the share. An unrealized gain, it's really kind of a paper gain. It's the increase in the share value. So when you look at your, balance sheet, your net worth statement, you'll have a higher value on those shares. But ultimately, it's a paper gain because the share price has increased, but you have not sold it. Now, this is still important because it increases your net worth. But it's critical to understand that there's realized gains upon selling the stock and unrealized gains, paper gains, when the stock appreciates in value while you still own it. When it comes to realized gains, we have two subtypes, as you know. We have short-term realized gains. This is when you owned, because you've already sold it, when you've owned it for less than a year. And we have what are known as long-term realized gains. And as you know, long-term realized gains is when you held the stock for more than a year and then you sold it. Critical thing with this for you as a shareholder and for you as a prudent tax planner, your capital gains are going to be taxed differently depending in part on your income, but really depending on whether or not your gain was short-term or long-term. Remember the big rule. You always want to favor long-term gains over short-term gains because long-term gains save you significant tax. And that's more money in your pocket and less money in your Uncle Sam's pocket. And of course, more money in your pocket means you have more money to, for example, buy more stock or some other asset class. Okay. So anyway, back to our jargon, back to our big picture. We know about the types, common and preferred stock, or we're going to get to preferred in a bit. We know about common stock. We know about the gains. One other piece when it comes to common stock, you may hear the term stock split. A stock split occurs anytime a company splits its shares in order to keep the share prices in a particular buying range. Lots of companies have as their policy a desire to keep their shares within a window of different prices. This makes the shares more attractive, especially to large-scale institutional investors. So oftentimes when a company sees its stock price getting too high, it'll do a stock split. Stock splits are typically expressed as, X for 1 or, X to 1, where the number 1 is your number of pre-split shares, and the value X is the number of shares after the split. So you might, for example, see a 2-for-1 share split. In this case, suppose that you owned 100 shares, and then the company pushes and clears a 2-for-1 split. Your 100 shares now are 200 shares. You know, if you have a 3-for-1 split and you originally owned 100 shares, those 100 shares split 3-for-1 or 3-to-1, and now you own 300 shares. So basically, your existing number of shares simply increases by the multiple of the stock split. Now, here's what's really important, because lots of people think, great, I just got twice as rich or 3 times as rich. Sorry, my friends, but you didn't. Stock splits have no immediate impact on the company's value. And after the split, the share prices will decline by the same multiple that the stock was split by. So let's say, for example, that you had, in this case back here, you have a 2-for-1 split. You originally had 100 shares and they were valued at 50 a share. After the split, you're now going to have 200 shares because that's the 2-for-1 split. However, your shares will now be worth $25. Okay, the value per share is effectively the inverse of the split. Note that here and here, your overall value, your asset base has not changed. Okay, so that's common stock. The second type of stock, let's wrap this one up real quick, is preferred stock. Most of you probably will not invest in this, but it's important that you know what it is. Preferred stock is a share of ownership in the company, but it's unique in that it's a fixed income ownership. When you own preferred stock, you are legally entitled to receive a fixed dividend per share. Corporation is legally required to distribute it to you, and as a preferred stockholder, you get paid out your dividend before any dividends or other residual claims are paid to holders of common stock. Okay, so that's our brief introduction. There's different types of stock. Again, you should be thinking about these things through the lens of advantage and disadvantage and risk and return. Okay, now going to that idea of risk and return, even though there's a lot of jargon coming up, it's sort of important that you understand that stocks are a really broad category, and within that category, there's going to be different classifications and different characteristics. So in this next section, I want to quickly give you a couple of big definitions, some jargon that you will often hear when you're reading about stocks or researching them or watching financial news, okay? So what are some jargon? What are some terms? What are some types of stock? Well, we can measure stock by what's known as its capitalization. The capitalization of a stock is basically equal to the number of shares outstanding times the price per share. So if a company has 100 shares of stock outstanding and each share of stock is worth $2, 100 times 2 would be $200. That is the firm's what we'll call market capitalization. So it's simply the number of shares that are held multiplied by the price per share. Okay. Large capitalization stocks, which are also known in the jargon as large caps, they're going to have a capitalization in excess of $10 billion. Okay, these are big companies. Middle capitalizations, aka mid caps, these are stocks that will have a market capitalization of between 2 billion and 10 billion. Small capitalization stocks, which are known in the jargon as small caps will have a market capitalization of below 2 billion. So one way to dissect or understand a stock is the stock a large cap, mid cap, or small cap? When you hear these terms, all you're hearing is the market capitalization. Is the company worth more than 10 billion less than 2 billion, or in between. No problem. Okay. Another way to classify stocks or to kind of like, explain them is as income stocks or growth stocks. Income stocks, they're not going to grow too quickly typically. But the key to income stocks is that year after year, they pay a consistent cash dividend that is on average higher than the dividends of other companies. This is going to be important, for example, for older investors or institutional investors who need to have streams of cash come in. On the other hand, growth stocks, these are companies which are growing faster than average. And critically, they offer the promise of much higher future profits. These companies are often not as established as income stocks. They tend to be newer firms. And what they're trying to do is grow. They're in the growth phase of their business evolution. This is the thing about growth stocks. They oftentimes do not pay dividends. Instead, as we mentioned earlier, growth stocks typically like to reinvest all their cash and all their profitability back into their operations. In terms of financial metrics, which we'll learn about shortly, we would say that, again, these growth stocks are going to have higher PE and PB ratios. That should not be rations, that should be ratios, pardon me. And we'll explain what that means in a bit. Value stocks, these are shares that, according to the people who evaluate them, what we'll call value investors, these are stocks that are basically underpriced. These are stocks that are trading at a low price relative to their fundamentals, their assets, their dividends, their cash flow, okay? Now, I want to be very clear. Value stocks are a category of stocks, and value investors, they look for underpriced stocks. But again, that's just a really abstract definition. In the real world, it's extraordinarily difficult to determine if any share price is adequately priced or overpriced or underpriced, okay? There's fundamental differences of opinion. But when you hear value stock, you're thinking about stocks that are underpriced relative to some subjective estimate of their true value. Another category of stocks, one that many of you have heard of, are blue chip stocks. Blue chip stocks are basically companies that have been around a real long time. They have very strong reputations. They typically dominate their markets, and they're considered blue chip because, at least relative to other stocks and other things in this asset class, they are considered solid and relatively safe. Again, I want to stress the word relatively. Stocks as an asset class are risky. That's why they have higher historical returns. But critically, what you need to understand is among the stocks, the blue chips would tend to have higher levels of relative stability and therefore relatively less risk. And the final type of stock that you might hear about are what are known as countercyclical stocks. They go against the business cycle. They're also known as defensive stocks. These countercyclical stocks are companies whose profits are less influenced by the business cycle. And in fact, some countercyclical stocks actually move sort of opposite the business cycle. These are important because these can act as a hedge. They can be a form of diversification. A well-diversified portfolio is typically going to hold some countercyclical assets so that if the market or the economy turns downward, you're going to have some assets still rising or maintaining value, okay? So those are your types of stocks. At this point, we need to now move in to a bit more of a technical sort of mathematical treatment of stock valuation. Now, I want to point out here, putting it in green because it's so damn important, massive caveat, massive warning here. The following is for your information. I want you to know this. It's part of being a good investor. It's part of being a good financial thinker. But again, I strongly discourage you from trying to analyze and evaluate individual stocks. You know I love you. You know I think the world of you, but there are people who are, with all respect, smarter than you, better modelers than you, and have information that you don't have. Okay, there are people whose full-time jobs are to analyze one individual stock or one individual industry. And my friends, while I love you and think the world of you, the reality is you as an amateur investor are not going to outperform a pro. And these pros who do this for a living, they're often wrong. So if professionals whose livelihoods are tied to this are commonly mistaken, there's very little hope for you and I as amateurs. So again, massive caveat, don't try to analyze and value individual stocks, but know how it's done, okay? Biggest takeaway from this is that a stock's price ultimately is, of course, the amount of money that an investor is willing to pay to get it. In turn, logically, this represents the investor's view of the stock's underlying, or what we call, intrinsic value. So at its core, the goal of stock valuation, okay, the underlying goal of stock valuation is in fact to determine a company's intrinsic value, its fundamental economic value, which will in turn dictate its share price, okay? Now, there are several theories and there's several methods that are used in the real world to do this, and I want to share a couple of them with you. One of the theories or methods of stock valuation are known as DDM models, dividend discount models. Under a DDM analysis or a dividend discount analysis, a stock's value is considered to be the present value. So we have a time value of money, right? Coming at you. The stock's value is considered to be the present value of all future dividends earned from holding the stock, discounted by the firm's required rate of return, okay? So under the DDM model, the dividend discount model, basically the analyst is looking at all future flows of dividends coming in. So this basically an annuity is what it comes down to, and then discounting that cash flow by the firm's required rate of return. And by getting the present value of those dividend flows, you get the, in theory, the value of the stock. Okay. Again, the price is calculated as the expected dividend divided by the discount rate. The discount rate is K minus the stock's long-term growth rate, which we'll call G. Okay, because we have to factor the growth rate in. So basically, under these models, the value of the stock would be the dividend D divided by K minus G, divided by the discount rate minus the firm's growth rate. Now, mathematically, these are really simple problems. When you get them, you know, in business classes or finance classes, they're fun to get because you can plug numbers in, get a return rate, estimate the stock, and feel really, you know, good about yourself. But hopefully you can see that in the real world, there's a lot of challenges to this model. I mean, how do you predict the future stream of dividends? How do you predict the company's growth rate? How do you determine what the company's required rate of return is? That's the discount rate. You guys know from the time value of money analysis that even small differences in the discount rate can lead to pretty wide differences in your TVM calculation. So it's critical to get the right discount rate. How do we determine that? It's hard to do, but that's the basic theory behind it. Another method is known as cash flow analysis. Under cash flow analysis methodology, the value of a company is assumed to be the discounted value of the company's future, what we call free cash flows. And basically, in this type of analysis, the investor or the stock analyst, they develop really sophisticated models that attempt to forecast expected future cash flows. Then, of course, they have to discount those back, and that leads to another question. Once you got the model, well, then what are you going to discount it by? And remember, even small differences in the discount rate or in the growth rate can lead to wildly different valuations. Third theory, or third type, is known as fundamental analysis. Under the fundamental analysis methodology, a stock's intrinsic or true value is based on its expected stream of future earnings. The expected stream of future earnings. In this methodology, analysts, they spend a lot of time trying to understand the company, trying to understand the industry, looking at the global industry, looking at the global macro economy, lots of data, lots of analysis, lots of intuition, lots of sifting through things to make conclusions. All of those are done to forecast future earnings, which again, you discount back. The one thing about fundamental analysis, the big takeaway, it suggests that you can identify some stocks that will, over time, outperform others, and therefore that you should only invest long-term in companies predicted to become industry leaders. And then the fourth type is what's called technical analysis. Under technical analysis, the price of a stock is determined really by supply and demand factors. Technical analysis is known for looking at historical price data, doing lots of analysis of charts, the movements of prices, all of which are trying to kind of gauge or understand subtleties in investor sentiment. You know, what are some of the psychological factors, fear and greed that the market bakes into it, okay? So those are a few of the schools of stock valuation. In valuing firms, in addition to the different theories or methods, analysts rely on a handful of really important measures and ratios. You hear about these a lot in the financial news. They are important in financial stock analysis. One big thing I want to point out before I share some of these with you, bear in mind that most of these measures or ratios or values, they mean nothing individually. It's a way to compare apples to apples. So these metrics that you're going to learn about right now, they can be ways to compare a stock's performance in the past to a stock's performance now. So to get some historical depth on one stock. They can also be a way to compare different stocks in the same industry, or to compare different stocks that have different risk characteristics. So remember, these metrics that I'm going to teach you, they're important and they can be useful, but they got to be used the right way. You know, you never make a decision to buy a stock just based on one metric or two metrics in isolation. These are part of a broader way of thinking, a broader way of analysis, okay? Probably the most important thing that you look at when you look at a firm are simply its corporate earnings. Corporate earnings, they're really at the core of stock analysis. And corporate earnings are simply defined as the profits that a firm makes during a specified period of time. Okay. Corporate earnings ultimately are one of the first things you want to look at for any company that you're interested in. Because the simple question is the company making enough money to fund its operations with a bit of money left over that can help fund future operations? So that's very important. So we'll bear that in mind. Another really important measurement is what is known as beta, AKA the beta coefficient. Beta is a measure of an investment's volatility. Beta is a measure of volatility, but specifically, beta is a measure of volatility compared to a broad market index for similar investments. So the beta of a security or the beta of a stock is basically a measurement of that stock's volatility in comparison to something else, and that something else typically being a market index. For large cap stocks, it's usually the S&P 500 index. So the S&P 500 index, widely known index, that is typically the market index that we use to benchmark large cap stocks. Here's the way that you look at beta. The average beta for all stocks in a market is by definition 1. And therefore, a stock that has a beta of 1 will typically move in step with the overall index. Okay, let's repeat this. We know that by definition, the beta for an industry as a whole or for a market index as a whole is 1. So if an individual stock also has a beta of 1, that means that that stock pretty much moves in lockstep with the broad market, with the broad index. On the other hand, a beta of greater than 1, a beta of greater than 1 indicates higher volatility than the market as a whole, and a beta below 1 indicates that the stock price is less sensitive than the market as a whole. So beta of 1 is the market, and therefore a stock with the beta of 1 moves in step with the market. Betas greater than 1 imply higher volatility than the market as a whole. Betas below 1, less than 1, imply lower volatility. So let's say, for example, that you're doing analysis and you determine that a particular stock has a beta of 0.8. This assumes, or not assumes, this implies, this means that the stock should rise or fall by only 80% of the market as a whole. So the fluctuations of that stock will be less than the fluctuations of the market as a whole. If, for example, the market rises by 10%, this stock will only rise by 8%. Okay, it's a little bit flatter in terms of volatility than the market as a whole. On the other hand, let's say you analyze another stock and you find that that stock has a beta of 1.8. This stock would be considered much more volatile than the market as a whole. And under the math of beta, if the market as a whole rose or fell by, let's say, 10%, then this stock would fluctuate by 18%. So that's beta. Really important number. There's a bit of math to it, but it's simple math. Just understand that beta is tied to volatility. Okay, and you need to understand volatility if you're going to put your money into something. Another big definition is earnings per share, also known as EPS. This is the firm's annual profit divided by the number of shares of stock outstanding. So EPS, earnings per share, makes sense. It's the firm's annual profit, its earnings, divided by the number of shares outstanding. Okay, EPS basically measures a firm's profitability on a per share basis. And this allows you as an investor to do an apple-to-apple comparison of different stocks within the same industry, for example, or of different stocks with the same relative risk threshold, or even different stocks across different industries. So it's a way to analyze on a per share basis and do some apples to apples. A really important metric is known as the price earnings ratio. The price earnings ratio is also known as the PE. It's also called in jargon just the multiple. The price earnings ratio is defined as the current price of a stock divided by its earnings per share over the last 4 quarters. There's a lot of ways to analyze and interpret and make sense of your PE number. One way to think of PE, and again, we're dividing the current market price by the earnings per share. So one way to think of the PE is that the PE tells you how much you have to pay in order to get $1 of earnings for a firm. The PE ratio, by definition, is how much you have to pay in order to have a right to $1 of the firm's earnings. PE ratios can also be seen as a sign of investor confidence, as a sign of underlying expectation. Higher PE ratios, at least in comparison to similar stocks, they may imply that investors have more confidence because they're willing to pay more for a share of earnings. If I say, well, these two companies have relatively equal risk characteristics, this one has a higher PE and I'm going to buy it, that implies that I'm willing to pay more money for $1 of earnings from that stock or that company. That might imply that I have more confidence in that company, in its management, in its products. Of course, the flip side is that stock might also be overvalued. So there's lots of ways to analyze it. If you were to take the PE ratio and invert it, you would get what is known as the firm's earnings yield. It's another mathematical easy formula. Another important, and I know my friends, there's a lot of jargon, a lot of math, just stay with it, okay? Another important metric is known as the price to book ratio, also called the PB, also called the market to book ratio. This is defined as the firm's current stock price divided by the firm's current book value. Book value sounds fancy, it's not. It's simply the shareholders' equity in the firm. It's simply the net worth of the company. And therefore, it's simply the net value of all the firm's assets and plants and equipment and patents and et cetera, minus all of its liabilities and debts. Just like you have your net worth on your financials, companies have their own net worth, okay? The book value is the net worth of the company. We think that oftentimes the lower the PB is, the less highly a company's assets have been valued. Another really important metric, especially when it comes to shareholders and a way to observe if the administration and management of a firm is doing its job for shareholders, is what is known as return on equity. Remember, equity is shares of stock. So return on equity is what are shareholders getting back for their equity. Return on equity, also called ROE, it is defined, it equals a company's net income divided by shareholders' equity. Okay, it reflects the firm's overall profitability from the shareholders' perspective. Pragmatically, in the real world, ROE basically captures just how effectively, or at times ineffectively, just how efficiently or how inefficient the firm is in managing its assets, its operations, its capital and debt structures. So basically, ROE is really important because this is basically a way to judge how well the firm is handling all of its operations, not just its product line or its sales, but its sales, its investing, its liquidity and cash use, its operations, all of those things, okay? Generally, we think that higher and or increasing ROE are going to be better than low or falling ROE. Again, ROE really important, but its true value is not as a snapshot, but rather looking at it over time or comparing the ROE of one firm to another. It's a great comparison tool. The dividend payout ratio, this is calculated as dividends per share divided by earnings per share. So the dividend payout ratio is calculated as dividends per share divided by earnings per share. This provides insight into how much of a firm's earnings are returned to you as a common stockholder. But remember, this assumes that the firm has a stated policy of dividends. Remember, a firm can be really good, really strong, and pay no dividend, especially if that firm is committed to reinvesting its cash, to plowing all profits back into the company, to grow market share, to expand internationally, things like that, okay? So anyway, my friends, those are a few of the different metrics, a few of the different measurements, a few of the key ratios that we look at when we take a look at stock. The final thing I want to point out is, since we have now this idea of stock valuation, we know some theories on how to do it. And since we also have now in mind a handful of different metrics, ratios, calculations, logical question is, why do stocks fluctuate? Which they do often and increasingly more with more volatility. So why do stocks fluctuate? And once you understand the different models and metrics, you can identify a handful. There's a lot of other reasons, but a key handful of reasons include changes in interest rates. Remember, a lot of our stock valuation, excuse me, was based on discounting flows of income or flows of earnings. Well, anytime interest rates change, companies have to probably change their discount rate, which, as you know from the time value of money calculations, will really change your ultimate valuation. We can have changes in the perceived risk of the company or industry. Critically, we can see changes or predict changes in the company's expected earnings or cash flows or dividends. This is why, for example, earnings calls are so important. This is why for many companies, to keep their stock price high, excuse me, they have to keep generating earnings. We can see changes in supply and demand. We can see broad changes in investor sentiment. And this one is really tricky to calculate because this is investor psychology, which, as you know from our brief discussions on behavioral economics and some of the psychology of investing, are all internal and oftentimes irrational. Okay, so we know now ways to evaluate a stock. We know some of the metrics. What's the next step in this thought process? And it comes all together with this. In theory, again, theory with all the caveats attached, okay? In theory, an investment is going to be acceptable only if the investment's expected rate of return, only if the expected rate of return meets or exceeds what we're going to call your required rate of return. You can think of this simply, going back to basic economic thinking, as a benefit cost analysis. Your expected rate of return is your expected marginal benefit. Your required rate of return is effectively the opportunity cost of making the investment. That's your marginal cost. So if your expected rate of return meets or exceeds your required rate, then in theory, you purchase the investment. Of course, it's very difficult because it's hard to calculate these things, but that's the theory behind it. Okay. The required rate of return, as we said, is the minimum return that you need to receive on an investment relative to, again, the risk that you assume in buying that investment. It's important to remember here that an investment's return is going to be composed of two things. Number one, its risk premium, and number two, what we would call in finance, the risk-free rate of return, which is typically seen, at least in most financial analysis, as the current rate on the United States T-bill. The T-bill is considered globally the most safe investment, and therefore the current yield on a US T-bill is a proxy for the risk-free rate of return. One way that you can estimate your required rate of return is simply to multiply any investment's beta by the estimated market risk and then add that to the risk-free rate of return. That's a rough and dirty formula. It's not perfect, but it's a good approximation, okay? So we will say that your estimated rate of return, your estimated required rate of return is going to be equal to the T-bill rate, which is the risk-free component, added to beta for that individual stock times the overall market risk, which is the risk premium part. You put those two together, and that will give you a rough and dirty estimated required rate of return. If you assume that you know an investment's annual average current income, and again, big if, massive if, theoretical if, but if you could estimate a security or a stock's future valuation, then you can calculate its approximate expected return. So let's take a step back. We said before that you will, in theory, invest in something if the expected rate of return meets or exceeds the required rate of return. We're going to use this formula here to determine the required rate of reserve. Now we're moving to the expected rate of return, assuming that you know the investment's, annual average current income, its dividend stream, and that you can estimate its future valuation, which is what all those valuation models are designed to do. You can calculate your expected return. Here's your formula. Your approximate expected return, and this is a big one, so I had to kind of spread it out. But it's right here. Your expected approximate return will be equal to your average annual current income added to the projected price minus the current price divided by the number of years that you're projecting. All of that divided by your projected price plus your current price divided by 2. Okay, it's a hairy formula, I get it, but it's really pretty simple if you have the pieces. Of course, this assumes that you are going to accurately be able to ascertain the future dividend stream and the future projected price, which is why we have those stock valuation models in theory. Okay, but again, if you have those numbers and you can plug them in, then you can evaluate the expected future return. You compare that future return to your required rate of return. In other words, you compare this big, ugly formula to this small and lovely formula. And if the numbers are in your favor, you invest, okay? But again, my friends, please remember my caveats. This is really, really difficult. It works out great in finance classrooms. It works out great in MBA classrooms. It works out great if you have an Excel sheet and some data. Just remember that being good on a whiteboard doesn't mean it's going to work in the real world. Remember my caveats. Okay, this is for your knowledge. It's so that you can understand how the modeling works, but please do not put your life savings in something based on this, okay? Let's be prudent with our investments. And really, as I said before, I strongly discourage you, and I'll leave it at this, I strongly discourage you from investing in individual stocks anyway. However, with that said, we can now move forward that depending on if you decide to invest in stocks or even mutual funds, what are some strategies that you can use? And I will offer you in this last piece several basic, simple, and efficient strategies that you can use if you decide to invest in stocks. And note that these principles will also apply to investing in mutual funds, which again, not offering you advice, but for the beginning investor is far superior than individual stocks. But with that said, let's begin, before I give you the strategies, by doing a quick recap. Both academic research as well as anecdotal evidence strongly suggests several things. Thing number one, trying to time the market, knowing when to buy in and sell out and buy back in to try to play off those ups and downs is massively suboptimal. You will likely fail at it and lose money. Idea number two, starting small is better than not starting. Idea number three, investing steadily over time is wise. Big research takeaway number four, diversification is critical. You do not want to have all your eggs in one basket. Research and anecdotal evidence finding number five, it's important that you as an investor plow any dividends or other earnings back into your portfolio. That's how you grow a big portfolio, because that's how you achieve compound growth. And big takeaway number six, minimizing fees and commissions increases your return and keeps more money in your pocket. If you accept, and I think that you should, these 6 pieces of both anecdotally based and research-based evidence, then allow me to offer you a handful of strategies. Strategy number one, the buy and hold strategy. This is simply buying a financial asset, obviously a good asset, one that you have faith in, one that you've researched, and not selling that thing for a real long period of time. This is a very cost-effective strategy. It allows you to get capital growth over time, and critically, it helps you to avoid the temptation to try to time the market, okay? And again, we're humans. We're flawed. We make mistakes. So it's important that you find ways and tools and mechanisms to avoid those mistakes, to force yourself out of those mistakes. Committing to a buy and hold strategy, which, going back to our previous video, would be a great thing to include in your personal investment strategy. Okay, committing to a buy and hold strategy will help you to avoid that temptation. Another strategy, a great one, the dollar cost averaging strategy. This refers to a strategy in which you commit to purchasing a fixed dollar amount of security at regular intervals. Doesn't matter if the market's high, if the market's low. Doesn't matter if you contribute a lot every month or just a little. You kick in money consistently, regularly, over time, regardless of where the market's at. This strategy takes luck and timing out of the equation, and critically, it adds discipline. And on top of adding discipline to your investing, it serves as a mechanism for what I have taught you is one of the most important things you can do, and that is pay yourself first. If you can commit to sending in, to investing, having it auto pulled out of your checking account, a fixed amount every month, and commit to dollar cost averaging in a good mutual fund, you're going to be ahead of the game. You'll avoid the temptation to time the market. You'll keep your costs low. You'll take luck out of the equation. You'll pay yourself first, and you'll grow rich in the long term in the process. Okay. A third critical strategy, I guess this is my last one, I guess there's only 3, is what is known, is that all of them? Yep, just 3. Consider a DRIP. DRIP stands for Dividend Reinvestment Plan. Under a DRIP, you choose to take any dividends that you receive in the form of more stock. So you know that a part of your return is going to be dividends. Under a DRIP, a dividend reinvestment plan, you opt to have all of your cash dividends not given to you in cash, but given to you in the form of more shares of the company's stock. This also works great for mutual funds. okay? With a drip, number one, you greatly simplify the process. Number two, you keep your brokerage fees low. You're gonna, in the long run, pay a lower tax rate on your dividends, so you get some tax savings. And critically, because you're rolling your money back in. You're not taking money out every month in the form of a dividend, but you're taking those dividends and having them put back in. You're plowing your money back in. Drips help you achieve the gold standard that we know as compound growth. And so, my friends, that wraps up this video. There's a lot going on. Stocks are complicated. There's jargon, there's analysis, there's numbers, there's theory. It's important, even if you don't invest in individual stocks, however, that you understand the stock market, because this is an asset class that will be important to your future wealth. Again, I reiterate, I do not believe that you should buy individual shares of stock. You should instead, I would advise, if I were to be giving advice to you, that you go more for mutual funds. They offer you better benefits and diversification. But remember, even mutual funds consist of shares of stock. So even though hopefully you will not immediately start buying shares of individual stock, it's critical that you know, as a financial thinking citizen, as looking out for future you, how stocks work. In this lecture, we've covered what stocks are, common versus preferred, some valuation models, a handful of the different metrics that are used, how to calculate the risk and return trade-off in terms of average expected return and required rate of return with a couple formulas, and wrapped it up with a handful of strategies that, while simple, can help you grow rich. Thanks for tuning in. See you guys soon. Take care.